Okay, good afternoon and welcome back everyone to our options education session. This afternoon, we're here to talk trading small futures with Jermal Chandler. Before we get started, I just want to first of all, Jermal, say thank you so much for taking your time out here this afternoon. Today, we're going to talk a little bit about options, talk a little about futures, and talk about the fact that you're recently getting into futures and the experiences that you've had. So first of all, thank you so much for joining us this afternoon.
Thanks for having me here. Really appreciate it. The folks over at the Small Exchange, we appreciate it. And at Tasty, we appreciate it as well. So this is a great opportunity to just have a casual chat about futures, about options, about the industry, and looking forward to it, man. It's been a while since I've seen you. I mean, we met 2 years ago in person, and it's been a whole lot that has happened since that time period. So really looking forward to this.
That's exactly right. We're going to keep things fairly light. We're going to have a lot of discussions around your experiences, our experiences of trading options and futures, and hopefully this will give you some sense for how you might be able to transition from options to trading futures. And I know many of you are kind of in that transition phase at the moment. So my name is Tony Zhang. But before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And what we're going to do today is we're going to do a very, very brief intro of futures contracts for those of you that are brand new to futures contracts, to give you a better sense for what they are, what type of futures products are available, the difference between ETF and futures, because there's a lot of similarities, and we want to talk about how the small futures actually really take advantage of the similarities that it has with ETFs for those of you that are familiar with those products, and talk a little bit about the type of benefits that you're going to be able to get from trading futures versus ETFs. And I think Jermal's background, which is actually in options, and the fact that he's now learning and he's actually trading some futures himself, that process of transitioning from options to futures, that's what we want to help everyone here on today's session learn a little bit more. So we'll talk about the small futures products. We'll actually get into a few trade ideas, a few trade setups based on what's moving today. And we'll try to go through as many live examples as possible. At the very end, we have both the Tastyworks and the Small Exchange offer for you here today. So as you said, Jermal, we met a couple of years ago at the SIBO. You previously were at the SIBO, but you recently joined Tastyworks back in February, about 6 months ago. First of all, welcome to Tastyworks. I know it's an interesting transition. It must be going from the exchange over to the sell side, in the brokerage firm. Tell us a little bit about your background, how you got started in your career. And I learned something new about you this morning, that you actually have an engineering background, something that a lot of our viewers actually have engineering backgrounds. So I'd love for you to talk a little bit about that and kind of how you got into options and trading.
Well, I got to be honest with you, where it starts at a little TV show called MacGyver, actually, is where it really starts at. As a kid, I really enjoyed that show. And I just always thought that it was cool that this guy could make something out of nothing by knowing the products and knowing a material and how to manipulate its properties. And that's basically what got me into a science background. I did chemistry undergrad. I went to Clark Atlanta University, as you can see, small school in Atlanta. And I did I first did research on what we call organometallic materials, which are basically just a lot of organic materials mixed with a lot of metals, so it can be like a lithium with a whole long chain carbon material. Did a lot of that research with a guy that I worked under. His name was Dr. Eric Mentz. And then after that, I started working with a mentor and friend, Dr. John Hurley, who ended up introducing me to superconducting materials. And that led my way to graduate school at the University of Wisconsin-Madison, where I worked in the Applied Superconductivity Center under Dr. David Larbalestier, where we did just some really cool stuff. I mean, superconductivity is, Tony, it's kind of out of this world. Just the research is kind of crazy, but a lot of it is just that. It's research. And so there were always hopes that you could, there are a lot of things that superconductors are used for. Namely for MRI machines, a lot of times they'll have, like, I think niobium 10 superconducting materials within those, and that's why we are able to get those images that you get. But the hope was to eventually replace copper stuff, right? For copper lines, for maglev trains, those type of things to use superconducting materials. The one that I worked on was bismuth, strontium, calcium, copper oxide. That's BISCO. And so that's what I did a lot of my research on. And then I actually also worked on lignocellulosic materials, which is basically wood. It's a fancy word of saying wood. And so I did a lot of wood epoxy stuff for a couple of years. And then I gave it all up, man. And I came into trading. And so I moved to Chicago 15 years ago, and I worked at Peak Six Investments, and that's how I got into trading. So it was definitely an interesting ride, but I always like to feel that the science and the engineering sort of helped formulated the way that I think and the way that I view things. And I certainly still use a lot of those tools that I learned from then. It taught me how to think. And, I think we joked about this early this morning. I think there's a lot of people in science and engineering that tend to gravitate towards this field because it's like a problem, or it's like a research project that you want to figure out. You figure there's a method, and there are methods, but the thing about the market is that there's methods until something changes. And, whatever strategy you might have been using might not necessarily work, all of a sudden. As far as options, you could be, a straddle seller, and that could work for like 3 weeks to a month. And then all of a sudden, vol gets really big, and the straddle that you were short, you're losing money on that now. Now, what do you do? Now, how do you change that, right? And so I think that's the thing that always draws me into the market. There's always something happening that's different. And, in those years at Peak Six, I traded with a momentum group, the dynamic hedging group, and we did really well, as you would imagine, in 2008. 2009 was kind of tough. You have to adjust once again. We were largely paying theta. We were largely long Vega. So, you're buying options quite often. That works great heading in 2007 when things are moving around. Heading into 2008, of course, worked wonderful. 2009, much like we've seen this year, or I should say late last year and early this year, where volatility is just dropping off. And so you have to adjust, you have to be nimble. And I think that's one of the big things that the market gives.
Right. And that's one of the things that I really want to discuss with you is actually your background in options trading, because it is quite unique in terms of the type of options trading that you were doing from the professional side. We tend to see a lot of professionals gravitate towards trading vol. They're predominantly short theta, short vega, meaning selling everything from cover calls to cash secured puts to credit spreads. We don't see a lot of professional traders long options, right? That's kind of what we always say. That's traditionally what retail traders do. So it's really interesting to hear that that's the type of trading that you did. And because to be a momentum trader, you need to have a strong directional view, which is something that we're going to discuss here today in terms of trading futures and the transition that you made from trading options to futures. So just also, my understanding is that you've recently come into futures trading, right? So your professional background is in options, and futures is actually relatively new to you.
Correct. Yeah. So and we'll get to that in a bit, but I guess to start, when I was at Peak Six, it was, when I after finishing the trading program, so it was about 9 months in, I started to get my own portfolio. And this, before I was in the momentum group, this is just kind of trading my own portfolio. I actually traded, the big thing here, I guess, and this is something that I think we're going to dive into later, but might as well hit on it now. The idea of risk. When you start in, especially with a smaller portfolio, you have risk parameters, you have risk slides that you have to pay attention to. And the newer type of trader that you are, those are a lot more stringent, as you can imagine, because you're still learning. So you have your training wheels on, so to speak. And so when I was working in that group, or I should say our trader training group, as I was beginning to hone my skills, you have smaller risk slides. You do have to pay attention to what we call ratios, how much how many long options you have versus short options, or long Vega to short Vega. So you're often paying attention to ratios, Vega ratios, theta ratios, and you have to be in line with that. The risk team is often paying it. I mean, the whole firm has that. However, the longer you've been trading, the bigger type of trader you are, well, you're able to talk to them about managing your risk, and you have shown that you can do that. But when you're starting out, you have to start out slow. And so that's how I started out. So I wasn't necessarily starting out with long Vega, long theta then. It was just a matter of what's going on in the market. Much like we talk about at Tasty, it was one of those situations where what's going on in the market, where's volatility at, where's the VIX at right now? Let's see, okay, if we're pretty, say the VIX is 11, 12, maybe we're thinking about being a little more longer Vega than anything, because we expect volatility to pop some at some point. But then about a year in, I ended up working with, and I honestly think this was the best situation for me. I ended up working with some more senior traders and trading in their larger portfolio. So all of us had a hand in their portfolio. And honestly, that's when I learned the most, because I was alongside senior guys who've been doing it for either 10 to 15 years. And that's actually how I learned the most. And it just so happened that that was a long momentum group, long Vega, long theta trading group. I should say paying theta trading group. And what we did often was look for breakouts. Now, this was something I think why it resonated with me. This was something I was trying to do when I first got to that firm. I was very familiar with, chart patterns, with cup with handles, with double bottoms, things like that. And I was often trying to figure out, how can I make this work with this new option knowledge that I found? And I just wasn't quite getting it. And I think those guys in that group kind of helped me get it, helped me figure out when you have maybe a better chance of making money on something that's going to break down, if you will, and look for times like that to buy those puts. Or, when something's about to break out to the upside, look for times like that to buy calls. Now, does it work all the time? No. However, being at a firm, you have a lot more capital. So you have the ability to not only buy those 30 delta calls, but you can hedge it with some short stock too, right? So now you're increasing your chances a little bit. But all that aside, like you said, it's very different once you get into the retail world. You don't necessarily have large capital like that to do those type of trades. And that's why it's a little bit better to try to find defined ways to sort of collect some theta so you can, sell options, if you will, because that may work out better for you in the long run.
Right. We're going to talk a little bit about retail accounts, trading with limited capitals, and that's why we're here to talk about small futures, right? Because we've spent a few of the sessions here over the past few months discussing the introduction to futures. Many of you are relatively new. And while we put up this slide, I do want to do a quick poll here. I want to get a sense for how many of you have traded a futures contract before. If everyone here could please just answer that question. I want to get a sense for the audience here. How many of you have traded before? How many of you are currently learning? And how many of you have never considered a futures contract? So about a quarter of you have traded futures before. Almost 40% of you say that you're currently learning how to trade futures. And about a third of you have said that you've never considered futures. So for those of you that have traded futures, hopefully this gives you a sense for the different products that you have at your disposal. For those of you that are learning, that's exactly what we're here to do, is to help improve your learning process. And for those of you that have never considered futures, hopefully this gives you something to think about as far as whether or not this is suitable for your portfolio. But a futures contract is, actually quite simple to understand in the realm of derivatives, I would say, Jermal. And you come from a long line of derivatives, all types of complex derivatives at SIBO. And I would say futures, out of all the derivatives, are fairly simple to understand, because it's really just a contract between two parties that allow you to assume or offset the risk of an asset over time, right? So similar to being long or short a stock, a futures contract gives you exposure very similar to being long or short a stock or ETF.
Yeah, no, totally. Yeah, two things. I mean, first of all, there was like a 68% attendance ratio on that. Guys, come on, get it higher. I'm just messing with you guys. But yeah, the funny thing is in all the time that I've been in this field, traded futures with a firm. It's very easy to click the buy button and sell button when it's somebody else's money, to be honest with you. People always wonder about that, but it's sort of a, something you train your brain to do. You do kind of at least I did. I kind of, got used to it. When it's your own money, it's a different story, right? It's a little bit of a different story. And so in all the years that I've been trading on my own, trading in my own personal account, I had never traded a future. And so, as you mentioned, I just started with Tastytrade in February, and we were talking, interacted with Frank Caberna and Pete Momat at the small exchange. And we just kind of were brainstorming, and we came up with this idea of a potential show where I would learn how to trade futures. Now, do I know a lot of the terms? Do I know that a future is an obligation? I am familiar with those for sure. But I always like to feel, and maybe it's because I went, to undergrad school for so long. I'm not a stranger of being a student, and I didn't mind trying to really sit down and learn something this time around so that I could get comfortable with actually trading a future. And so that's what we did. We created a show called The Leap, from futures to options, where basically one day Pete is taking me through that process, and then one day Frank is taking me through that process. And we do it every Tuesday and Thursday from 12:15 to 12:45. And it's fun. It's really fun to learn something and then eventually apply it. And so about 3 weeks in or so, I actually finally traded my first future. I got the small US dollar future. And because I just was interested in the dollar because of the way that it was moving around, because of all the things that have been going on over the past year. Yes, we do have some inflation worries, if you will, in the market, because not everybody, 54% of the population, they say, has been vaccinated at this point. And so we're reopening. I mean, you have over 1.9 million people that are taking flights again, as far according to TSA numbers. You have, you look at Open Table and people are dining out again. I mean, the world is coming alive, or I should say the US more than anything is coming alive. And so I wanted to see what was going to happen with this dollar. It's been some moves, and that was why I chose to make that dollar trade. But I got to tell you, I mean, it took, I took something, it took some time for me to get used to the idea of trading a future for the first time, because I had never done it.
Yeah, and I'm glad that you're here, because now you get to talk to our audience about your experience of transitioning from options to futures, because I'm sure many of you are probably currently in this scenario. As many as 40% of you have responded to yes. And I know most of you here trade options. 40% of you are learning how to trade options. So if you can, equate to that, please type yes into the chat window of you're in the process right now of learning how to trade futures. And as far as futures goes, there's a lot of different futures that you can trade. What I have found, and this goes back to my futures trading days, which is about 10 years ago now. I was a day trader of E-mini futures, and that was all I traded from about 8:30 in the morning to about 11 a.m. was trading E-mini futures. And I remember the couple of times that I decided to stray outside of my lane into some oil futures, into some agriculture futures, and I absolutely had my butt handed to me because I just didn't understand those products, right? They're just completely different beasts. It's not like going from trading GLD to trading TLT, where the two are very similar to each other. You get a good sense, but really you have a very different experience trading different futures contracts. And that was really some of the things that really challenged me and kept me kind of in my lane. So I'm really happy to kind of have learned about the launch of the small exchange. And when Tom and Michael and a few other small exchange folks came to me about a year ago to tell me about these products, I genuinely thought, you guys are absolutely crazy trying to launch brand new futures contracts and compete with the CME. Until I spent some time looking at these products and understanding them a little bit more and seeing just how how well positioned they are, in my opinion, for someone who's a small retail trader. It's a small, standard, simple ethos that they have. So I'd love to hear a little bit about kind of your learning experience of getting started with these futures products and kind of how they fit in your portfolio.
Well, yeah, and I should have mentioned it on the last slide, but it doesn't matter. We don't have to bring it back. Keep it here. But the idea, one of the things that was intimidating is I think you kind of hit on it. Each future has its different multiplier. There's all these different things that you got to know about it. I mean, with options, for every one option, there's 100 shares multiple, right? For every one option, whether it's call or put. Yes, you have to get used to delta, and you have to get used to, calls generally, you're thinking you have to decide the way you want to do it. You buy call, you want it to go up. You buy put, you want the stock go down. You have to get used to all that stuff. But once you do, that's it. And I'm not saying that's so esoteric in futures that you can't, but I think that was always intimidating to me. I think one SPOO's future is like there's 50 times that times, the notion to get to the notional value. I remember not only myself, but guys more senior on the desk asking those questions. I want to buy some silver futures. Wait, what's the multiple there? I just thought that was always intimidating, right? So fast forward now, working at Tastytrade, and we came up with this idea. We're talking about doing this show, and that's when I learned. I think the easiest thing about the small exchange, I mean, all this stuff that we have on the screen here is awesome, but the truth is that everything is pretty simple, right? Like all of them are 100 multipliers. I mean, they all expire except for the new small oil futures. All of them expire on the third Friday of the month. So there's not all these, different things that you have to remember and compartmentalize. It's kind of this uniformity, right? Like you can use a certain, amount of capital. You don't have to use this exorbitant amount of capital just to trade a future. And I think that took a lot of the intimidation out of the process for me. And that's why I was like, hey, let's do this and let's walk through the process and let's see how these all work, because I thought that that was cool.
Yeah, and I think standardization is what options traders are used to. As you said, each contract is 100 shares. We know that each contract on the monthlies expire on the third Friday, weeklies every single Friday, and everything trades in one tick, 1 penny in a tick in terms of the underlying itself. So it's just we're used to this standardization, and when we step into the futures world, it's just like a whole nother world that we have to learn. And the small futures really solve that, right? Everything is standardized in the same way that options traders are used to. 100 multiplier on every contract. Each tick is 1 penny or $1 for every 100 for each contract, similar to trading 100 shares at a time. And they all expire on the third Friday, the same time that your options expire in terms of monthlies. But like you said, with the exception of the oil futures that recently just launched. So you're really getting and the other thing that we haven't discussed here is really the efficiency that you get with futures, or sometimes what we call leverage, right? Or it is leverage rather. And I think we should address that, because you talked a little bit about risk before, and I want to come back to that, because I do think risk management is key for retail traders to understand. But with futures, you get a little bit more efficiency in your capital. So you're going to be able to trade these products at with the margin requirement that's substantially smaller than if you're trading an equal amount of an ETF. So if you're trading GLD, if you're trading TLT, that's 50% margin that you have to put up in order to trade them. Small exchange products, you have a smaller margin requirement, so you have less capital to control the same amount of size, and there's no pattern day trading rule. And I think that's really something that a lot of smaller accounts who want to trade a little bit more actively in some of the products like interest rates or intraday equity indices, you can do them using futures that you don't have to do when you're trading equities.
Yeah, boom, boom, boom. You hit all of them. I mean, the efficiency part of it, like you just said. So that dollar trade that I decided I wanted to get into was trading around 144.40 at the time. So therefore, the 100 multiple means I could control $14,000 worth of that particular future, and I owned that for just a little over $200. So I have a pure exposure play to the U.S. dollar by doing that. And my thinking behind that was, and I think people, this is one of the things that I learned throughout time. People don't always view it in this way, but if if you're long stocks, you're basically short dollar, you're selling dollar, right? And then and vice versa. So I just kind of use it as a way to hedge some of one of the stock portfolios that I have onto the side, right? And so but again, it's a pure play to be able to play. And I've always wanted to trade the dollar. And I don't know about many of you, but I mean, there's not many retail ways that you can trade the dollar. I mean, you can type in Dixie all you want, but a lot of times you're not going to be able to find it. So I just thought that this was a cool way and again, efficient way to be able to trade the dollar. And a lot of a lot of the same reasons, more recently, been looking at the 10-year. It's hit, some lows, almost near 3-year lows, I think. I could be wrong on that. Maybe no, I'm thinking dollar. I'm not sure. We were definitely in the below 1.5. You probably know better than me, Tony. I've just started messing around with the dollar. I mean the 10-year, but we were definitely below 1.5 last year. I mean, we were on serious lows. Of course, we rebounded above that. We were looking at 1.6 for a while there. They were talking about 1.7. We saw what it was doing to technology stocks. Soon they were saying we're going to be hitting dollar. A lot of people still were going to, not dollar, $2, or I should say 2%. A lot of people still feel we're going to hit 2% towards the end of the year. Will it happen? I don't know. But in the meantime, I'm looking at this level of 1.5. Can it get back to 1.6? I believe maybe it will, although we did see it dip below 1.5 today in a decent sized way. So, there is the ability to be able to play these and not use as much capital, I think is just so appealing to me.
Yeah, and I can't tell you the all types of crazy ways that I have tried to come up with to trade the dollar using equity products. Everything from UUP, which is the dollar ETF. It's not a particularly great product in my opinion. to trading FCX, some of the mining stocks that are very sensitive to dollar. We've traded all types of stuff to mimic the dollar, but you're not really getting true exposure to the dollar. You're actually getting exposure to a lot of other things at the same time. And I don't particularly recommend it all the time. So this is, like I said, when I saw the small futures products, it really changed my mind in terms of what retail traders can get exposure to to get actual exposure to what they wanted to get exposure to, as opposed to getting some exposure to something that they want exposure to, right? So, as far as the equity indices, this is something that's easy to get access to in pretty much any market, whether you're trading futures, options, ETFs, you can get access to equities. But when it comes to the dollar, when it comes to precious metals, when it comes to treasury yields, this is probably by far the most innovative product that I've seen, hit the market. The fact that you can now trade treasury yields directly, that was really the one thing that changed my mind about small futures, because, every time we talk about the yields, we have to do an inverse of that. We're trading a bond ETF, and we're not trading the 10-year directly, right? TLT is a long-term bond. It's actually 20+ year bond ETF. So you're not getting true exposure to what you're really looking for. That and every single day on TV we hear about the 10-year yield. We chart it, we talk about it, and every discount cash flow model that analysts use to price companies are used these types of yields, yet we can't trade them until the small future was listed on them. So I thought these were, and recently we just have the US crude oil that now you can trade and get direct exposure to, as opposed to trading XLE or USO. Those are two products that I think are pretty terrible proxies for actual oil exposure, if you will, totally. For equity investors. And recently, in my understanding, is that the small exchange is just about to launch marijuana futures, being able to get exposure to 2022 marijuana stocks here in US and Canada. So a lot of interesting, I would say, products being listed these days, giving retail traders direct exposure to these products, as opposed to using proxies or some things that are close enough that we have to replicate with using equities. So Jermal, I think a good segue now is to talk about a few ideas, right, that you and I discussed earlier today. One is the US dollar. This is one that, for those of you that follow me on CNBC, we talked about this a few weeks ago. Carter and Mike had a bearish view on dollar. I took a different view. I'm more bullish here on the US dollar for a few different reasons. One, just technically speaking, this 143 level here has held on the dollar index. I think that this is potentially a double bottom that could bounce. Now, but when I look at the dollar, I don't particularly trade the US dollar on technicals. I trade more on macroeconomics for me. And when you look at the dollar index, it really has a very outsized weight to the euro, right? 57% of the weight is the euro dollar. And from my perspective, looking at the euro dollar, it favors the US dollar right now. Everything from interest rates, there's about an 80 basis point carry that's in favor of the USD. And just as you said before, the US is reopening, certainly much faster than we're seeing in Europe. The economic indicators coming out of the US are substantially stronger than Europe. So for those reasons, I'm bearish on Euro USD, which, this is some of the more confusing parts about FX, right? Because you're talking about two sides. So I'm bearish on Euro, so I'm bullish on the dollar, and that's why I'm expecting more of a bullish view on USD. That's my take. I'm curious as to understand kind of your view on the dollar, what your thoughts are and how you choose to express it through a small future.
So yeah, I mean, I can see the double bottom here, and I think what you said was really important. Like, this is one of those that is a huge macro thing. There's a lot of things that this is playing off of. The pricing pressure. I mean, again, the reason why I like technicals, the reason why I like things like RSI, because personally, I really view them as you can see the true greed and fear in the market, which a lot of our market is made off of. And that's why I feel a lot of these things usually work, right? And again, it also depends on timeframes. But like you said, this is also more of a macro situation. So along with, and I think it's important to help people understand, like, we look at these with those technicals. It's almost like tools in a bag. We look at the technicals. Hey, what's going on? Ooh, that's a nice double bottom. And on top of the thesis, that I'm about to lay out, you laid out yours, but my thesis too is somewhat similar. We have seen reopenings. I laid out a couple of the things that are already going on, and most of you people see it. I mean, you're interacting with more of your friends. How much money have you spent in the last 2 months versus what you did in January and February? I mean, it's kind of interesting, right? Like everybody is out and doing different things. The pricing power, we're seeing people spend more money. The idea is eventually the job market will pick up. That's more people spending money in the economy overall. So that's kind of my thesis on the dollar as well. And, stocks are kind of on highs, right? I mean, there's not kind of, they are on highs. They have been on highs. We're hitting, new highs, it seems like every day or every other day. So as a result of that too, I'm saying, well, why not get long the dollar here as a measure of sort of getting short stocks, if you will. So it's a couple of things altogether, I would say, that I'm looking at the dollar for long in that way.
Great. Everyone here may have a different view, right? That's very well, you could have a completely opposite view and say, I think you're outright wrong. I think the dollar is going to continue to decline here because of the amount of easing that the central bank continues to do at a faster pace than any other currency out there. For the most part, our central bank is devaluing at a faster rate than any other currency. That is a bearish view on dollar, and I completely understand that view. And that's actually the argument that Mike and Carter made for short the U.S. dollar. And this is really where the futures market is, where we all go and express those views, right? So Jermal and I, as bullish views on USD, would take a long futures position. So just to show you what that would look like.
And that's
so
our view. You're right. I mean, right now that is a key caveat. We don't know when the Fed is going to stop tapering, and that is the thing that is weighing the dollar down, if you will. We'd have no idea. Tony and I certainly don't know. Tony has some pretty powerful connections. I don't know if he's down with Jay Powell right away, but that is something that is affecting the dollar. So, it is as a result of that, I think that's why. And I think we're going to talk about this a little later too. The idea of being nimble, we're not all in. I'm not pushing all of my chips into the dollar right now. I'm just saying, I think it's an interesting play here. And I think you are too.
And I think the mechanics of trading this, right? If we look at this chart of the 10-year chart, I want to pull this up again. As you can see, the 10-year chart is currently at $143, and you can think of it as $143. And when you buy a futures contract, and this is what I love about the small futures contract, is every single contract you purchase is a 100 multiplier, which is the equivalent of buying 100 shares of an ETF that's currently priced at $143. So it's just like buying an ETF that's currently priced at $143, and you're buying 100 shares of it. But if you were buying 100 shares of an ETF that's priced at $143, you would have to post $14,317 in cash, or half of that in margin if you're trading a margin account. However, when you're trading this in a futures contract, to buy this one contract, which is the equivalent of buying 100 shares of it, my buying power effect is only $181. So that's just a little over 1% of the total contract value. A $14,000 contract, I only need $181 to purchase that contract. That is the capital efficiency that we're talking about. However, that also means that you could, in theory, let's say you had a $10,000 account, you can actually control close to $1 million in US dollar, if you will, by leveraging up your capital. And those are two things that I do want to touch up on in terms of risk, right? So the margin requirement means that you can control a large amount of capital with a small amount of capital, but it also means that's a double-edged sword, right? You can also take that to an extreme and basically say, okay, I only have a $2,500 account, but I can control a $250,000 position effectively with that by leveraging my capital. So Jermal, I do want to talk a little bit about how that works, right? Because your margin requirement is what you're going to need to keep in order to stay in the position, but the notional amount that you're actually trading is what's actually going to change the P&L of your total account size. And that's really important, especially for those of you that are managing risk.
Yeah, absolutely. I think, one of the things that we've definitely seen from the past year is and this is exactly why we're doing this, the participation with retail. We've seen a lot of people realize that they can become self-directed investors. And along with that, comes great risk and great rewards at the same time. But risk, paying attention to your risk is a really important thing. And so understanding the two things that you just said, understanding what your margin requirement is, and also how much you can control. I mean, just because you're putting up $180, you can actually lose, with a decent sized move, you can lose $100 just based on, what you have. And you can lose more than you're even putting up. And so I think it's important for people to understand that. This is one of the reasons why, I think it's one of the big things we always talk about at Tasty is the idea of trade small and trade often. You can trade small, get an idea of how the position works and how it moves. Yes, the dollar does not have 5% intraday moves, but anything could happen. We don't necessarily know what the central bank could say. And I have seen times where dollar or different currencies, and you've seen it too, have had big moves. I think the what was it? I can't remember, a couple of years
Swiss franc.
Yeah, I mean, the yen had a huge move. I think it was like 7 or 8 years ago. Things can happen. So it's always smart to pay attention to your account, understanding your risk levels and knowing, what can happen with certain type of moves. So trading small and trading often helps kind of keep you level with regard to risk.
Right. And the good thing about this is that, many times with options, we buy a call option and we say, if the stock went up by 5%, the question is, how much money do you make, right? And you really need a bit of calculus to figure that out. You got to figure out delta, you got to figure out gamma, you got to figure out how much you lose theta. With futures, it's much simpler, right? It's just like buying 100 shares of a stock. So if a stock goes from 143 to 144, I know I'm going to make $100. If the future goes from 133 to 134, I know I'm going to make $100 if I'm long. If it goes from 143 to 142, I lose $100. Really simple to calculate in terms of potential risk to reward. So that if it reaches back up to this 147, 148 level here, and I bought it at 143, I'll know I make about $400 on that trade if I bought one contract, $200 if $800 if I bought two contracts. And instead, if it falls below this double bottom and breaks below, how much money I have to lose. That's really, for those of you that are familiar with trading stocks, trading this won't be such a big leap. As far as why FX has such low margins or such a small amount of margin requirement to control such a large position, it comes down to the fact that the dollar doesn't move very much. So that's why you're able to control a much larger position for the capital that you have to put up. But that, I think that's a good segue into looking at the 10-year. We've been talking about the 10-year a lot. It's what's moving right now. So let's talk a little bit about this, right? Because the 10-year recently, has been in this range-bound mode between 155, 175 or so. And we recently saw the breakdown here this morning. And a little surprising to me that you have March CPI numbers come out that have, strong inflation numbers, yet bonds have taken off and kind of almost eased in terms of their expectations for inflation. So this certainly seems to me a bit of an interesting counter move to what seems like an intuitive, should have been a rise in interest rates as inflation came in. I'd love to hear your thoughts a little bit about the 10-year and how you're kind of playing this.
Yeah, I mean, I'm a little confused, Tony. I mean, I thought, there was actually this steady dip, as you can see, over the last couple of days, leaning into the number, and I thought that was people anticipating, the high number. We're not surprised by the number. I mean, I know it beat expectations. I think it was 5% versus like 4.2. So, but overall, we know that there's inflation. We can see it. I mean, you can almost touch it right now, like it's happening, and so. Of course, dare I say, it's the idea is it's transitory. Who knows if it is transitory? Could mean 6 weeks. Transitory could mean 9 months. We really don't know. But I'm a little surprised of the big dip today. We just dropped through 1.5. As we can see, it's been a while there since we did that. That goes back to March. So, I'm still kind of I'm contrarian on this one. I mean, even though it's dipped, I'm contrarian. I think, we're looking at a bounce at some point again, because I do think sooner or later we're going to, I mean, it's hard to compare year to year, but prior to everything, we were at, a 2.2 or so in the 10-year. And so I think at some point we're going to have a steady rise over time. I just think right now there's a lot of movement going on in the market, and there's a lot happening, and so people are using this opportunity to probably get out for the time being. But this is more of a long term one, I think, for me. This and the dollar, I think, and so that's the thing about it. I mean, yes, well, we should be remiss in talking about these are June futures. They're going to expire next Friday. So yeah, I just initiated a position in the 10-year, and it is what it is for now. But the idea is we do have the ability to roll to July come, next week sometime.
Yeah, exactly. So, I feel the same way. I feel that this is just like, but I do want to say that a few weeks ago, before we had, or maybe a little longer than that, maybe 4 or 5 weeks ago, before this whole inflationary debate got started between whether it's transitory or permanent, it almost seemed like everyone on the street felt that the interest rates were going up to 2%, right? And generally speaking, I think whenever everyone thinks one way, the markets tend to move in the opposite direction. And right now, this also feels a little bit counterintuitive, right? And now it feels like everyone feels like interest rates heading lower and that inflation is transitory. It's not going to be a problem. And perhaps that is the opportunity to, take a bit of a contrarian view here. And for those of you that joined me a few weeks ago with Frank, I think you learned that interest rates is a very contrarian type, mean reverting type product, right? So when we see this kind of extreme move to the downside, and you really have 5 straight sessions, and if you look at the long-term chart here of 10-year yields, I don't know that you're going to see too many 5-session moves to the downside. I haven't seen that many in quite some time. So this is fairly sizable move in a 1 week's time period for interest. They move lower, and potentially that is the opportunity to play for a bounce. Now, again, you may disagree, and that's really what makes the market. So the futures contract here, just to make clear for everyone, when the 10-year futures are trading at 1448, that means that the 10-year yield is 144.8 basis points. So it correlates to the basis points exactly. So when we talk about basis points, like 150 basis points, 200 basis points, those are direct numbers that you can actually trade with these small futures. Unlike back in the day when we were options traders, and many of you still are today, if you felt futures are going to rise, you would have to first find a bond ETF. Many of you would trade something like TLT. It's really difficult to figure out what you want to trade, but you can trade TLT. I've traded KRE, which is a small bank, regional bank ETF that tends to be pretty sensitive to interest rates. I've traded XLF. I've traded just about everything under the sun that really didn't have direct exposure to what I wanted. And I'm sure many of you that are probably one of the most common questions I get a lot of times is, how do I get an ETF that gets me exposure to this? And that one thing is not available, really through an ETF. I get questions like, how do I get access to platinum? How do I get access to US dollar? How do I get access to this? And they're always just trying to find proxies, but we never had something really actually to trade. And the small futures really now allow you to trade the interest rates directly. For example, if let's say if we felt that this was a counter move and we thought interest rates were going to go higher, you can use the small futures. You can see it's currently trading 1446 by 1448, only 2 cents bid. Jermal, I don't know about you, but I've been placing a lot of my orders at the midpoint. When I see the spreads this tight, I'll just place the order at the midpoint, and usually I get filled within 10, 15 seconds. Otherwise, I might move them up 1 penny just to get beyond the ask. But largely, I've been able to get filled on these midpoints. I know a lot of people have said that there's not a lot of volume here, but I do want to be very clear. There's a difference between low volume, which usually reflects a new product. As you can see here, I just placed it at the midpoint. I just got filled in less than about 10 seconds or so. Mm-hmm. So this is to minimize my transaction costs as much as possible to try to get filled near the midpoint. This is a practice that we practice when we're trading options, right, Jermal? When we never place our orders at the bid ask, we always try to get filled at the mid, if not better. And this is the same, thing that I've applied to futures trading, and I've been able to get filled very nicely near the midpoint on most of my trades.
Yeah, I mean, you always want to go mid for sure. Save yourself a little bit of loot. Like you said, those spreads aren't that wide here, although something just widened up. But I think it's the end of the day here. Yeah, I mean, looking at the chart too, it's I always think back to when I actually interviewed at Peak Six, and one of the things that they did was to test and see your mettle with the idea of whatever trade or something you pick. And so, the idea was the fork in the road, and you're going, down a road, and are you gonna take the advice of your friend in the car who says they know where to go? Both of you are not necessarily sure where you're going. Are you going to take your friend's advice? They think they know where to go, or are you going to take your own? It was just test. It was a test to see if you'll stick to your trade. Now, again, I'm willing to stick to my trade because I'm not too big into this dollar trade right now. It's a smaller position and I can manage it, and my risk is fine. But it is one thing, the old momentum bells start ringing when you look at what we were talking about a second ago and you see the volume on the chart. Today was a relatively decent volume day. And so as a result, like you said, a lot of people, I think you put this perfectly. Typically, when everybody's one way, it eventually will change. And when it does change, everybody's going to be looking for the exit or whatever. And so this almost kind of looks like that today. And we could see some more selling pressure. I'm not sure. But as a result of being nimble, as a result of going in small, I can and have the ability to be able to purchase more if it gets to better levels.
Right. That's exactly, what being small allows you to do, as you say. And I think that's exactly what you're trying to say is being flexible, right? Or have the ability to be flexible by trading small. When you're trading huge size, you don't have that flexibility. You can't scale in and out of a position. But when you're trading small, you can say, oh, let me get some exposure here. If it goes down a little lower, I can still buy some more. I'm not taking on a huge amount of risk. If this declines another 5 basis points, I can handle that kind of risk, right? And that's one of the things that I did want to talk to you a little bit about, your background from Peak Six, because, the one thing that I think retail traders never get trained on, and this is something that I think all professional traders get trained and drilled into them, is that risk metric, right? It's while they teach you about trading and they teach you about reading the markets and the charts and getting a sense for what direction things are moving in. That's what they teach you. But there are certain rules that you have to follow with respect to risk management. And those are rules that you cannot violate at all. Otherwise, you're probably out of a job. And, as retail traders, we don't have that lesson. No one forces us these risk management rules on us. We're kind of on our own to figure that out. So I'd love to hear a little bit about your insights into, just how important risk management was to your trading career at Peak Six, and kind of how you've carried that into your personal account.
Yeah, Tony, it's really an interesting thing with regard to that in trading. I think it's something that we don't harp on enough. I mean, the truth of the matter is we all have to learn how to manage our emotions around wins and losses. Particularly, well, I don't know, I wouldn't necessarily single one out of the other. They're both particularly interesting. You know, I I've had times where I've had big wins, and that caused me to get more aggressive. And honestly, there's a lot of traders and trading firms who will tell you that that's a good thing because you got wins, you're on a hot streak. It's almost like baseball, right? But it's I mean, but sooner or later you can miss, right? And then you think you don't miss, and then you keep going. And so you have to learn how to manage those emotions. Now, at a trading firm, the best thing about it is that you usually have risk slides. Doesn't matter how you feel about the win or loss. If you get close to your risk slides, you have to adjust and you have to do something. And what I mean by risk slides are, at a trading firm like I was working at Peak Six, you have portfolios. You're trading, 100 to 200 different symbols, and you have positions not only with options but with stock in all of them. I mean, you could have, some calls. Let's say, what are we in? We're in June now. You could have some long thread. You could have some calls in July, but you could have some puts that you're long and an earnings month, and then you have a stock position that gets you to neutral on all of that, right? So you're long both those calls and puts different months, and you have a stock position that gets you to neutral deltas and all that. But you're paying theta, you're long vega. That's the idea of what you do at a firm. You have a position on, if you will, and so you can have that in Amazon, and then you have a different type of position that you're short vol and say, well, let's just say Tesla, right? Get something like that. So that's, you have a long vega, and let's say you're long vega in Amazon, long 1,000 vega in Amazon, you're short 1,000 vega in Tesla. You're flat, if you will, right? But not really. You're exposed to moves, and so that's kind of a portfolio. How do you say you extrapolate that to about 100 to 200 names? How do you keep track of that? Well, that's where tools comes in. And that's where these ratios that we talked about before. Now you're looking at a portfolio from a ratio standpoint. I'm paying here, but I'm short here. I'm collecting here. A lot of times you may come in and you're like, what do I want the market to do today? Right. And that's trading a portfolio. But at the end of the day, you also have these risk slides, if you will. So what happens if the market or in your beta is the SPX? What happens if the SPX moves 1%, 2%? Then you widen those out, 5% on each side, up 5%, down 5%, up 10%, down 10%. That's how you sort of look at a portfolio like that. I will never forget what happened on, I think it was September of 2008 when short selling was banned. We saw moves that we never thought we would see happen on any given one portfolio on that day. The look on some people's faces, including myself, it was nuts because all of a sudden you look at your risk slides most times, okay, mark it up 1%, mark it up 2%, because those are normal moves, right? But then you have outside moves on times like 2008 and times like we saw last year. So that's how you're looking at risk in those type of situations. That was my training in looking at it at a portfolio from a risk slide point of view. Totally different when you're in a retail trader. Now you have to look at it from the standpoint. I think, you start out by how much margin you're using potentially in an account. Most of the time in an options account, you're not using margin. Some of you may be, but what all positions are you have on? How much can you lose? What's your max loss in any one given position? If you're short a strangle, then obviously you're exposed to potentially substantial losses to the downside and potentially unlimited losses to the upside. If you have an iron condor, well, that's defined, right? So that's a different situation. If you're collecting on an iron condor, you know that the most you're going to lose is the difference between strikes in either one direction. So if you're paying, say you're long those calls, well, then the most you can lose is what you pay. So that's premium, right? So those are the different ways you got to look at it. And you really have to think about it in those ways. What's my max loss? What's my max gain? Rarely are we going to achieve max gain. What's your max gain on long calls? There is no max gain, right? So if you're long call, say for example, I know the AMC took a dive today. Some of you probably thought about buying some calls, even though that upside vol is rich. But what are you going to really get out of it? Well, say it doesn't move, and say you're long June calls and it doesn't move. Those are going to come in, right? And so you are paying premium. Now, maybe you're fine paying that premium. I know people who are, but you have to look at risk in that way. How much money could I potentially make or lose? And you can't always just put on a position and say, oh, I can make this much. I expect to make this much. I think a lot of us do that, but you have to look at it realistically. So risk is a huge thing. How much risk can you handle? We all have different risk tolerances, but even along with that, you have to look at your positions realistically and think about how much you can make or lose.
Absolutely. And I always tell investors here, I get probably, one of the most common questions people ask me is how much money can you make, or what type of returns can you make trading options? And I always tell them the question you should ask is not how much money can you make or what type of returns can you expect, but how much are you willing to lose? Because that's going to dictate how much you can potentially make on an investment. You have to control how much, because you have limited amounts of money that you can lose, right? If we have unlimited amounts of money we can lose, then in theory, we can chase really these high return opportunities. But in reality, you have limited amounts of capital and you need to make sure you protect that capital so that you can survive to trade another day. If you blow up your account, guess what? You can't participate on tomorrow's moves and be able to capture those returns in the market. So the most important thing is not how much money can you make, but how can you protect your portfolio? So with that, Jermal, thank you so much for your time here today. Before we kind of jump into Q&A, I do want to just let everyone know, some of you are currently trading small futures contracts. I do want to ask a question here, another question. How many of you have actually traded a small futures contract before? How many of you have traded other futures contracts? And how many of you have never traded a futures contract before? I just want to get a sense for the audience here. Okay, so about 12% of you, 13% of you have already traded a small futures contracts. 13% of you have traded other futures contracts. And about 70% of you say you've never traded futures before. So first of all, I hope for the 70% of you that have never traded a futures contract before, that this is inspiring for you in terms of taking a look at other products that can potentially be beneficial to your portfolio, especially if you followed me in the past of trying to trade a dollar or have a thesis on interest rates or have a thesis on gold or oil, you can trade them through futures and get a better exposure to those products. But for the 13% of you that say that you've traded small futures products, there is a subscription that the small exchange offers. It's a one-time payment of $100 that gives you a 50% discount on the commissions to trade these products. Jermal, I don't know about you, but I've been trading these fairly actively. I'm paying 25 cents a contract right now. I can basically have them reduced by 50% by paying a $100 subscription fee. If you plan on trading these actively in the future, or even right now you're trading them, this could give you access to it. And the small exchange does send out a weekly newsletter that gives you access to trading ranges. And I think that's very useful for those of you that are trading the interest rate future to understand what is the daily range, and when it gets outside of the range to look for mean reverting strategies. So a lot of additional information that you're going to get for weekly from the small exchange for that subscription. Yeah. And Michael, if you don't mind sharing that link with everyone in the chat window for the small exchange. And also for those of you that are looking for a brokerage firm to trade these small futures, currently they're not available at all brokerage firms, but they are available at Tastyworks. So you can open up a Tastyworks account at this link here on your screen, which is trade.optionsplay.com/tasty small is the link that will allow you to open an account at Tastyworks to trade these futures products at Tastyworks. And you can have, if you want to sign up for a subscription, they'll give you a code that you can give to Tastyworks, and they will apply the 50% discount on your trading commissions for these small futures. So with that, Jermal, let's answer a few questions if you have a few minutes here. I know we have quite a few questions come in, and if you have any additional questions, there is both a chat window and a Q&A window. If you could please type your questions into the Q&A window, and we'll try to answer a few questions before we wrap here for today. Wallace is asking, Jermal, how do you see your engineering and STEM background contributing to your success in options and futures trading? Wallace also has an engineering and chemistry background.
Yeah, that's a good question. Wallace, I think if I could put it into one word, it would be persistence. Because the first time in undergrad when I took organic chemistry, struggled with it, but I worked through it. I would say and people don't believe me when I say this, but when I took physics, for whatever, I didn't take physics in high school. I don't even remember. I actually took AP chemistry senior year, but I never took physics. And I took physics for the first time. I can't believe I'm about to say this, but I took physics for the first time sophomore year in college, and I failed. I mean, like the first time I ever failed anything, and I didn't get it. I took it again the next semester, and I got a D. And then I really started to question myself. I'm not going to lie. For the first time in my life, I was just like, why don't I understand this? I've never, I was an A/B type student. And I'm not just saying, I know there's a lot of you out there. I didn't always go to the teacher. I didn't do that until probably later in college and graduate school for sure. But I didn't always go and ask the teacher questions. I just kind of sat in a class, I'd listen, I'd pay attention, and whatever my grade was is whatever my grade was. And sometimes that'd be an A and sometimes that'd be a C, most of the times. I couldn't believe when I just couldn't figure out physics. So I took it 3 times. And by the time I took the 3rd time, I had a really good professor. His name was, Dr. Brown, who almost sounds like Back to the Future, but he really was. He was a physics professor named Dr. Brown. And as a result of his tutelage and me just staying with it, I got it. And I would say that's one of the things that I maintained was persistence. So when I first got into options trading, it was tough for those first, 6 months. We're doing classes, and this is at the firm, and you're not getting paid a ton, and you're doing classes. You are on the desk. You're trying to talk to traders who don't really want to talk to you, but you need to get their feedback on your trade ideas. Does this make sense? From a vol perspective, all of those type of things. And we mostly traded volatility at the firm. We didn't necessarily always, outside of that momentum group. Before I got to that, you're learning how to trade volatility on a whole. So the persistence is really probably the thing. I mean, I learned a lot from the different classes you take in science and engineering, but I would say it was the persistence more than anything. Same thing as a result of different, research projects that I did. persistence. Not all the research project worked the first time. So I would say that's probably the biggest thing.
Yeah, and I will say, I think, I mean, I don't have a science background per se. I mean, I did have a finance degree, but I did go to a science high school. And I will say the one thing that really allowed me to better understand calculus for those of you that better understand options for those of you that come from a science or math background is basic calculus. Just understanding integral derivatives, the relationship of a curve, and I remember in high school learning this stuff and saying, there's no way in hell I will ever have to apply this in real life. Until I got to trading options, and you learn about bond convexity and you learn about options. It's like, oh, that was basic calculus, and there's actual use for this stuff. And then as you get older in life, you realize there's a lot more science stuff that actually uses calculus that's really useful for other things. But I remember in high school saying, there's no way in hell I will ever have to learn how to calculate the area under a curve. Yet, as an options trader, that is basically what I do all day long. So
that is exactly what we do. That's a really good point. I mean, that's another thing. True. Yes. When it gets down to it, you're right. There are a lot of practicalities with it. The idea of understanding something as a derivative, what does that really mean? Those are things that you learn in differential equations and things like that. What is a derivative? And then you get to like VIX, which is a derivative of a derivative. And what does that mean? It means something moves really fast, right? And so it's almost like getting to the idea of a half-life in chemistry and things like that. Understanding those, you don't want to hold this forever. It's something that's moving really fast. It's decaying really fast potentially, or expanding really fast. So yeah, there are those elements of it too. Good point, Tony.
Right. So this is a great question from Francois saying, what size of position percentage should we take in a portfolio? And I think this is a really good question, especially for retail traders, right? And there isn't a number per se that everyone has to stick to, but I think everyone has to have a number, and you need to learn how to stick to that number. And that number is going to be different for each user. But Jermal, I'd like to hear a little bit about do you have a percentage in mind that you generally stick to as a percentage of your portfolio when you place a trade with respect to options or futures?
Yeah, it's probably somewhere between, I'm probably like 2 to 5% of my portfolio, depending, the situation, depending on the type of trade I'm looking at, but somewhere around in that range. Like you said, there's no real rule of thumb. I mean, everybody's portfolio size is different, but I'd probably say I'm somewhere in there.
Okay. For me, it's 2% for options, 5% for stocks, and usually a little less for futures. And like I said, if you have a higher risk tolerance than me, you might want to adjust that a little larger. But the important part is to stick to one number day in and day out. Don't do 2% today, don't do 10% the next day, and fluctuate, because that's when you're going to see more inconsistencies in your trading. Jermal, he's asking, how long in average do you keep a position? Let's focus the attention here to futures for now. Generally, how long do you think you hold on to a futures position for?
Well, I'm still so new to them. So, I mean, it's only been about a month now. And I've had my dollar trade on for the entirety of that time. And I actually started in May. I rolled it to June, still have it. The 10-year, I just initiated that position, so stay tuned for that one. There's no quiet answer on that. But yeah, that's what it is for futures. For the options, it's a little bit different.
Right. Job is saying, besides interest rates and VIX, what other futures mean reverts? Job, as far as the futures that are available here on the small exchange, and largely the futures that are available in general, I would say interest rate and VIX are the two primary asset classes in general, if you will. It's not even futures, just asset classes that are truly mean reverting, both on a small scale and generally speaking on a larger scale. I don't know if you have any thoughts on that, Jermal.
Yeah, I mean, VIX is the main one. When you hear people talk about mean reversion, you're mostly going to see that. If you pull up a VIX chart, I mean, you'll see how that works. Long-term average on VIX, they often say is 19. Again, the VIX index, they always make, that was kind of hammered in my head when I was at the exchange, but it's because of all the different misunderstandings around the product from time to time. But anyway, I think that's the biggest one when you're talking about mean reversion. That's usually it. Other than that, I mean, it's hard to say. There's the idea. Just keep in mind the idea of mean reversion doesn't necessarily always apply to other futures with regard to what we're talking about. Again, we're saying volatility has a certain level. You can't say the dollar has a certain level. It has a certain probably average over a certain time period. And then within that, you could say, well, I expect it to mean revert to what it's been over the last 30 days. So that's one way of looking at it. But I think, I think it's important to break it down in those different ways.
Yeah. And I do think that when you're looking at individual currency pairs, like let's say euro dollar, on the long term, we tend to have a mean reverting property on those, but they have seen, over the years, at least, when you look at most of the major currencies there, we have seen some major drifts away from those averages. So it's not a particularly, unless you're willing to hold on to trades for literally years, possibly decades, and willing to take the pain in the meantime, I don't necessarily know that currencies are a great mean reversion trade per se.
Well, and let me add one
Okay.
more thing to that. The
Yeah.
reason why I
Mhm.
think we often say the VIX mean reverts is because, for people to understand, just getting to the simple calculation of the VIX for every, if you're saying, the way it works is that because there's 252 trading days in a year, if the VIX is trading 16, that means it's calculating 1% daily moves in the SPX. So as a result, I mean, that's often what we see, around 1% or so within that time frame, 0.5%, 1% moves in the SPX. So that's why, you can't say 24 is mean reversion, because we don't see 1.5%. If you're seeing 1.5%, 2% daily moves, we usually consider that to be volatile, whether it's up or down. So I think that's the important measure of it.
Right. Well, Jermal, I just wanted to say a big thank you for your time here today. Thank you so much for taking the time out and sharing with us your background, your experiences, and kind of the transition that you're currently making in futures. And I hope to have you back soon and give us a little bit of an update on kind of how you're progressing with your futures trading, as I know many
Tony,
of us are in that same boat.
Tony, I really appreciate you having me on. From the moment we met, I think you're doing great things with options play. I appreciate you and having me on here. At the Small Exchange, we thank you. Tastytrade, we thank you from the whole Tastytrade family. This has been great, and really hope it was helpful for a lot of people. Like I said, I'm still learning a lot of things too, even though I've been in this business for 15 years. And so this has just been a great collaboration to hopefully, get some new eyes on things and have them look at things in a different way.
Yeah, we're all learning new things every single day, even I am. So I hope for those of you that are currently in the process of learning how to trade options or learning how to trade futures, this is hopefully helpful for you and inspiring for you to take a look at some of these products. And with that, I want to thank everyone for taking the time out here this afternoon. We will send out the recording to you as soon as we finish here today so that you can review them with the slides and the recording at your own pace. And please feel free to send us any questions you may have. Thank you so much and have a great evening.